we're going to talk now about equity and specifically how you should plan investments into stocks. Now, over the last several weeks, there's been volatility across global equity markets, and that has to do with the developments from the Ukraine-Russia border. Even as we speak, tensions are rife, and that's causing global equity markets to witness sell-offs, and our markets are no exception. Let's talk about this in a little bit more detail. Vivek Bajaj, co-founder of StockEdge, is joining in to talk a bit more about this. Thank you so much, Vivek, for taking the time, and always a pleasure speaking with you. You know, the propensity, I think, for people, individual investors, to follow their icons, to follow their heroes in the equity markets is very high, and that you see somebody who's made a killing in the stock market, who's made money over a period of time, and you want to emulate them. I want to discuss this a little bit more. Why is this not such a good idea?
Thanks, Alex, for having me. So I believe you're talking about just copying what the other big investors are doing in the market. Well, I always believe that we should not get influenced by people, but there is no harm in getting inspired by people. So every individual in market has a style, has a purpose, has a way of doing things. And we should definitely get influenced by them, that inspired by them, that how they're doing it on their own. And we should adapt those things and create our own framework. But just doing a copy paste of the stock ideas from them is actually not a good idea, because ultimately you will never come to know when they have sold it at what price. And then you will probably crave that, oh, I still don't have, I still have that stock and the person has sold it. So it's not a great idea, especially when in these kind of market scenarios, when things go tough, the other person will know how to manage the emotions. Whereas for a normal person, it's so difficult to manage the emotions during the tough time. Only when you know the concept, only when you don't know the reason why you have entered that stock, you can manage to withhold the pressure which the current market is offering.
That's a fair point. So let's get into some of these factors that individuals should bear in mind, right? What are you doing, or what are you advising people in the context of where we are right now? You're seeing geopolitical tensions on the one hand. You're seeing the unwinding of easy monetary policy in the US that's playing out. Bond markets are also seeing volatility. That's having a bearing on equity markets. So all told, there is now a question as to whether we're hitting pause on the bull run, and how does one position themselves. The easy money that people were getting in the equity market seems to have now completely gotten over, and people are now ducking for cover. So in this context, how does one approach it?
Well, if someone who has studied 100 years of financial market, for that person, it's not a surprise at all, because this is something which was expected. Timing it is obviously difficult because anything can be a trigger point for all these things. Today, it's Russia, Ukraine. Probably some other day it could be something else, because market was overheated. There is no doubt about it. But having said that, you see, in last 2 years, Nifty or small cap or mid cap, in fact, small cap, mid cap right now is witnessing more corrections vis-a-vis Nifty. And people are saying this, that the large caps are holding on to the Nifty, and the real pain is seen in the small cap and mid cap. But if you see, for the last 2 years, small cap and mid cap have given phenomenal returns. So because they are high beta, the corrections will also be higher. So to answer your question, so this is not something unusual. After 2 years of phenomenal rally, a consolidation rally, a correction on consolidation is something which is expected. Market has corrected by 10%. So it's not that the bull market is ending. This geopolitical situation obviously has to be taken into mind. If something goes extremely wrong, which I'm not sure. I mean, it's still a chance that world may not go for a war, because there's a huge cost of war. And today's world, it's very difficult to assume that there will be war. So I think the correction is there. Stocks have corrected, small cap, mid cap has corrected, because that was due for a correction. For someone who is a value investor or a growth investor, you always see there is an opportunity in crisis. And we have witnessed that in March 2020, and we are witnessing a kind of a micro crisis right now. So for a long-term investor, you can't time the market. So continue your SIP the way you have planned. But yes, for a momentum trader or momentum investor, market has taken some money from you. There's no doubt about it. You have seen many stop losses getting triggered. So it's okay, accept that, because momentum always gives you high return and there is a loss which is happening. So move on, prepare for the next momentum which will come into the market. And market momentum will come. It is not practically possible that market will stay for long without any momentum.
From the perspective of the long-term investor who's invested in a basket of stocks, one would think that this investor, a lot of investors have been a little aggressive considering the kind of run that they've seen. But now I'm guessing that, Vivek, the strategy will have to change just a little bit, right? So the question is, would you go in for a change or review of your portfolio, take cover for a little bit just to weather the volatility, or do you buckle down and say that these are stocks that I'm going to invest in over the next 10 years. I have a lot of conviction in these stocks. They're seeing correction right now. I'm going to build into these positions even more, use these opportunities to buy.
Alex, I want to be very honest here that, 10 years is too long frame, and especially in the new world of metaverse, we don't know how the universe will progress. So I don't think 10 years 3 to 5 years is the max one could actually objectify their decision making. In this kind of a market, the best way to plan is to do regular investments. You cannot just invest in one stock at one price and leave it and with an expectation that after 5 or 10 years I'll make good money. So my humble submission is that sure, the leadership will change, the sector leadership will change, because what has happened in last 2 years, probably the same sector may not work. For example, let's talk about banking sector, okay, or let's talk about auto sector. Now, last 2 years, barring few specific names, these sectors have not done much. Maybe coming 1 year, 2 year, you will see lot more action happening in those sectors. So sector leadership will change, participate in them, but that too, do not invest in one single go. It has to be paced investment. So if the market comes down, you are not under pressure, you still have cash to invest. And if market goes up, you are happy to increase your bet in the market because the market is trending quite well. So, it's very clear in the equity market, people who are long-term investor for a period of say 3 to 5 years, for me, it's always advisable to pace your investment journey.
So what, according to you, are the key parameters that should determine whether a stock should be in your portfolio or not?
Well, again, it depends upon what kind of portfolio design, portfolio construct you want to put in for yourself. So there are some people who are extremely conservative, passive people. So for them, focusing on companies who have hidden values, and we know that those companies will stay in India for a long period of time. For example, State Bank of India or Reliance or Kotak Bank, etc., who are not just one company. They are like mother of so many companies. So those are like value which you would like to pick. So those are for people who are conservative and who doesn't want to take a very active interest in the market. And there are some people who are very aggressive and they want to be actively engaged in the market. Then momentum becomes an important play. So it could come from any sector. There is a flow of liquidity from one sector to the other sector. And that flow of liquidity generates momentum in a sector where the money is going. So for active people, identifying the sector where momentum is going and parking most of the money in momentum would be advisable. So whether your portfolio, let's take a model portfolio. Let's say you have 100 rupees, then for a conservative person, probably 70 to 80% should be in value plus growth. And for an aggressive person, probably 70% should be in momentum, because you know that momentum is giving you short-term opportunities to participate and make quick money out of the market.
Absolutely. You know what? I think you've more or less summed up how a person's approach should be. And you also said something I think is very important, Vivek, which is that no one trend lasts forever and you need to play the momentum as it comes about, right? So thank you so much for taking the time. Always a pleasure speaking with you.
Thank you.